What's up, everybody? Welcome back to The Contrarian. My name is Logan. Today I will be talking about why the current situation with Russia and Ukraine has provided the Federal Reserve the sort of assurance that it needed in order to go forward with more quantitative easing. And this is obviously a very different stance than what the market is taking right now. Right now, the market is currently factoring in between anywhere from 5 to 7 rate hikes in the current year, 2022, of 25 basis points. So this would be very significant action on the Fed. And this isn't just coming out of the blue. This has to do with guidance that the Fed has given in the last year in terms of wanting to combat inflation. Now, inflation is at 40-year highs on both the consumer price index as well as the producer price index. So inflation is very worrisome right now. Obviously, we're seeing it make headlines, especially recently with Charlie Munger talking about how inflation is really a very bad situation to get into, especially when inflation begins running out of control. And he's actually said that he would bet on the dollar going to zero over the next century. So this is not to be taken lightly, especially somebody like Charlie Munger. Warren Buffett tends to be a lot more soft-spoken. He doesn't really speak his mind. Charlie Munger does speak his mind a little more. So it's just really, inflation is getting out of the Fed's control. It's getting thrust into the media a lot more than they would prefer. And because of this, the Fed has had to come out and say that, yes, we are going to raise rates. Yes, we are going to taper our asset purchases at some point, even though we haven't yet. And so we're going to try to fight inflation. Now, the current situation in the economy, before Russia actually invaded Ukraine, was already weak. So GDP results were coming in a lot weaker than expected. The final 2 quarters of 2021 were a lot lower than expected, and 2022 is already coming in, much, much lower than what was expected last year. And so the economy is already rapidly decelerating. Economic growth simply is not there. Even with the current level of quantitative easing that the Fed is doing, the growth just simply is not there. And so the Federal Reserve already had a very difficult situation that they would be trying to combat, high inflation on the one hand, and on the other hand, they're, trying to raise rates and reduce asset purchases on an economy that's already extremely weak. It's a lot more weak than, mid 2018 to the end of 2018, when the Fed really had that, taper tantrum, as it's called, and the markets were really spooked, and they effectively had to reverse course and say, yeah, we can't raise rates, we cannot continue to raise rates, and we need to, in fact, lower rates. And so effectively the Fed learned their lesson back then. I don't think that they would try to do that whole thing over again and, essentially have the same result. That's somewhat of a contrarian stance out there. Some people believe that the Fed are just complete idiots and that they would do something like that. I don't think that, in my mind, that just does not make sense for them to go ahead with that all over again. Now, the Fed has had some bad signs other than inflation. In the last couple of months, bond yields have spiked. This is a really bad sign because the bond market is somewhere around 3 times the size of the stock market, and it's commonly referred to as the smarter of the two. So the bond market is commonly referred to as, generally more intelligent, generally taking into account, kind of real economic circumstances, and the fact that bond yields have, rallied a lot in the last couple of months is not a good sign. Now, the Fed really doesn't want that to happen. Effectively, when bond yields reach a certain point, that they're not there yet, but effectively, if bond yields were to continue rallying, the U.S. would not be able to pay its debt. It would not be able to service its already existing debt, and it would have to issue new debt, in fact, to service the debt. So even with 100% of tax receipts, it would not be able to service the national debt, and this would be just a really bad sign out there. Most people would begin to be very worried if that were to happen. Now, this is before Ukraine and Russia. Now with Ukraine and Russia, now we're seeing oil prices spike, energy prices spike, even in the U.S. Unfortunately, the U.S. currently imports significant amount of oil from Russia, so oil has been most impacted by Russia and Ukraine. And so the U.S. is limited in terms of how how much they can actually sanction Russia, because we are in a way dependent on Russia for some of our oil, which is definitely not ideal. But this whole situation with Russia and Ukraine just further impacts the economy, and it also gives the Federal Reserve a sort of backdrop, what could also be called an excuse to not fight inflation. And this is really what I am looking for. Is I don't expect the Federal Reserve to actually go through with, the 5 to 7 25 basis point rate hikes that they were forecasting, that the market has been pricing in. If anything, I would expect them now to kind of reverse course, be a lot more cautious in their language, a lot more dovish in their action. And this is kind of confirmed by the meeting that Jerome Powell had a couple days ago. When you'll be watching this, he mentioned that he would be taking into account the current situation in Russia and Ukraine in terms of the decisions that they would make. And he's now talking about just a 25 basis point rate hike in March, when before the market was more, thinking maybe a 50 basis point rate hike might, be what they would expect. So already the narrative is beginning to shift. And the main question to ask now is, what could benefit if this does shift? If the Fed actually does shift from, trying to fight inflation to, hey, we really cannot fight inflation just because the economy is so weak, because the supply chain crisis is really not being fixed. And if anything, with Ukraine and Russia, it's now getting significantly worse. The Fed is going to shift to being a lot more, quantitative easing all over again. And it does make sense, because the Federal Reserve, nobody on the Federal Reserve wants to go down in history as being the person who really disrupts things and suddenly reverts course from a path that the Fed has been on for the last 50 years, ever since getting off the gold standard. They're not going to suddenly get off the path that they chose to go down 50 years ago of easy money and just expanding monetary supply ad infinitum. They're not going to stop doing that all of a sudden. In other words, easy money is just not going to suddenly reverse course. And so unfortunately, the Fed really has one of three choices at this point. They can, one, prolong the current system that we're on as long as possible. So, whenever a crisis or a recession does occur, they need to, stimulate the economy with ever more amounts of money, and potentially have more fiscally type minded stimulus, such as what happened under COVID, of more direct payments to consumers, things like that. That's option number one. Option number two is they could suddenly reverse course. They could raise rates. They could just reduce their asset purchases, stop purchasing assets entirely and let the whole system collapse right now. And option number three, they could, get together with some other central banks, have essentially a new Bretton Woods type of agreement, and just, wipe the slate clean, essentially default on their debt, or a lot of their debt, and, start over. And options 2 and 3 are really not their preference. They don't want to have, a massive disruption to the system. So their incentive is definitely to go with the status quo and keep things as they are for the longest amount of time as possible. So it really doesn't make sense for them to suddenly choose either of those other two options. And COVID has provided a really good reason for them to go, infinitely more quantitative easing the last 2 years than they had been doing before. And, essentially, I would argue that Ukraine and Russia does provide a good reason for them to continue that a little bit longer. Now, obviously, it does come to a point where it just, the cat is out of the bag. Inflation is, much hotter than it is now, even as I hate to talk about it, but it is going to get significantly worse. The Fed is going to have to try to fight inflation at some point, but I don't see that happening just yet. And so, between now and then, whenever then is, I do think that potentially even growth, some of the things that have really underperformed in the last 8 months when the market has been expecting the Fed to fight inflation have been small caps, growth. Gold and silver haven't performed well. It's a bit debatable as to why, but mainly small cap and growth, I do think could actually perform very well when the Fed does, in fact, begin to shift their stance on fighting inflation. Growth obviously is impacted a large extent by the rate at which money can be borrowed, essentially the cost of money. growth is impacted a lot by that. Investors really do not want to be in growth when interest rates are going up. So growth has suffered a lot in the past 6 months to a year, as well as small cap. So it's kind of these two areas where I do think the most opportunity would be, when the Fed does kind of begin to shift their narrative, as they are beginning to do. So all this being said, I'm curious to hear what you guys think about this topic. Just let me know your thoughts down in the comment section below. If you liked this video, just consider subscribing to this channel and giving it a thumbs up. If you didn't like the video, give it a thumbs down and let me know why down in the comment section below. I just hope to see you again at some point.